How much are we going to care about these numbers? How much are people just going to look through them, disregard them, make a bet on a vaccine, and keep going?
Yeah, good morning, Joe. Andrew, the challenge of this earnings season is that there's so much uncertainty in the market that I think folks are going to look past this, right? The near-term uncertainty right now is far greater than the long-term risks, which is a very unusual situation for the markets. And so I think folks are going to primarily look past this. As you can see from how the market is responding to news about COVID, closures in California, folks are recognizing that 2020 is just a mess. And so they're looking for 2021. They're looking to see how fast we're going to get out of the healthcare crisis so that people can get back to work, so that earnings can recover. So there'll be information in these numbers. I mean, our view is look beyond this. Be wary of investing in the whole market because some stocks are just extremely expensive, and pick your spots. We find that there are still some opportunities out there, and banks may very well be one of those, but it's going to take longer potentially for those to recover because that really depends on a full-throated economic recovery.
So, Darryl, let me ask you, given that the market does seem to want to look through whatever these numbers are going to be or not, and there's sort of a see no evil, hear no evil, we're going to think about 12 months, 18 months from now. What do you think the market call right now is on in terms of expectations? Is this a 12-month out that everything is fine again? Is it 18 months out? Is it 24 months out? What's the bet given the multiples that we're seeing in the marketplace right now?
Good morning, Andrew. So we still think it takes a while for this market to heal. So the consensus is down to $125 EPS for this year. We're slightly below that. And then we don't think you get back to the all-time 2019 EPS highs of 163 even next year. We think you'll probably be 145 to 150. I largely agree with Joanne, but I think there's some really important news to watch out of this earnings season. So we've got our eyes very much fixed on what happens with corporate cash positions. We know companies are sitting on war chests with both issuance and then what they've conservatively held in cash. So we want to know what's going to happen with dividends and buybacks. I'm certainly watching margins because it's important to watch for how much margin deterioration we saw through this and any guidance that companies can give us going forward. And then the third thing that's really important to me is what are companies going to do with CapEx budgets? Q1 CapEx was still largely intact, but I think Q2 CapEx is largely going to be pretty abysmal when you look at it. So we need to understand that war chest of cash they're sitting on. Are they willing to spend any or all of it in the second half of the year, right, and into 2021? And I'm guessing that's probably not something we're going to see a big prevalence of.
But I'll ask you, and either of you guys can take this question. We're going to see Delta Airlines numbers in just a little bit. What can you take away from that? Beyond trying to get some kind of semblance that there's solvency at these institutions and that they're going to actually make it to the other side, how much can you really? How much are you really going to be able to make heads or tails of anything there?
Well, You're right. Darrell's right to point out that the cash flow is really critical. We're looking really carefully at balance sheets and cash flow because, as I said before, you don't want to be in the whole market at this point. There's just too many parts of it that are very expensive. So our view is to look beyond this quarter and even this year and find the elements of the market where there's still secular growth, of which there's plenty if you look carefully, but not pay too much for it. We have a few ways that we do that, and that's a way to avoid both the risk of the quarter and also to find the companies with good balance sheets and that have much better growth prospects out of the quarter.
Hey, Darryl, before we go, talking about stocks that have been on the move and on the move higher, we talk about the tech stocks, which have effectively held the market up or at least kept things going here. You look at the multiples on those stocks right now. Do you think when it comes to earnings season, I don't think we'll see it this earnings season, but over the next 12 months, do you look at those numbers and say they're going to grow into those numbers? Do you say that just the multiples moved in a way and that you're buying into a multiple story? What is it in your mind?
I think it's a little bit more of the latter. I think you are growing into the multiple story. I mean, the reality is capital flows to where growth resides, and there is just no debate and doubt that growth resides most acutely in the tech sector today. And until that dynamic changes, I think you still have to, we're still most favorable on tech, have been for quite some time. It's been the largest and best performer, of course, in the portfolios. It's given the most attribution back to portfolios in positive returns. So we still like tech here. We do think at some point valuations could get stretched beyond what investors should pay. We just don't believe that you're there yet today, given it's one of the few places where you can still get sizable top-line growth, solid balance sheets, big cash positions, and we think growing earnings into this story.